Hello everybody, welcome back to a brand new episode, and tonight we're talking about stock splits. So it's a very simple one. All I ask you to do is like and subscribe, because that's all I ask for these absolutely free videos. All I want you to do is like and subscribe, and you can get all the content on this video for free. So we're going to jump straight in with stock splits here, and we're going to start off with what is a stock split. But first, I'm going to give you some basic background context. So basically, when a business initially decides to put their stock on the stock market, they have to decide on a number of shares they wish to sell to the public. So this is obviously going to be the maximum amount of shares on the market. And this is quite an influential thing, because obviously that's a maximum amount on the market and things can affect this. So depending on how demanded a stock is, share prices can rise and fall. So market demand is a big factor in price, as we know. But basically this can also cause a problem, because when prices rise too high, they can actually put some investors off. Now we've seen this in a few stocks recently, Apple, Tesla to name a few. The prices are so high, and it's understandable that can put some investors off. When you're paying over 2,000 for a stock, that can make some sense. So this can make the stock harder for a company to sell, and this can basically detract some investors and deter some investors, so they wouldn't even invest in the company, and that's harder to make the stock sell. So basically it can make sense for a company to want to reduce prices of each share. And one way of doing this is actually through splitting existing shares. So this means that you're basically dividing all the shares that you have by a certain number. But we're going to get into numbers in a minute. But basically, for example, if I had £5 in a £5 note, for example, and I got £5 coins back, I would have the same amount of money, but it would just be in 5 different things instead of one thing. So you can imagine how this one's going to work. So I'm going to just show you a basic diagram of how this one works on the next slide. So let's move over, and you can see here, so first we have a full circle, and on the second diagram, please ignore the messy lines and the line through the middle which wouldn't go away, but there we go. So in the first one we've got a full circle and it's 100%. In the second one we've got a full circle and it's 100%, but each quarter is obviously worth 25%. Well, I mean, not in this wonky diagram, but let's just pretend it's perfect. So each quarter is worth 25%. So this would be a 4-to-1 split, basically. And that's understandable, because obviously the first one is 1 and then it's been split into 4. So 4-to-1 means that the price of the share has been divided by 4. So we're going to get more into that one in a moment on the next slide, but I just decided to give you a diagram there. So what does this actually mean? So investors basically have more shares in the company, however they are still valued at the same price. So that's like I just said with the money example. If I had £5 coins and then £5 notes, a similar thing, but you know, that's just one example of describing it. So a very simple one to understand. The shares will be valued the same, however different factors can actually force the share price up still, but we're going to get into that one on another slide. But there we go. So there's some other key things to note before we jump into the last slide, I do believe. So with the stock split, basically, oh, sorry about that. That was supposed to say when the stock split. When the stock split is implemented, the price automatically will change on the market, and that's understandable, that's obvious. So basically the price changes quite immediately, and that forces the share to be divided, as you can imagine, and therefore the share price is going to be lower, because obviously each share is smaller. Anyway, so the decision to make the share split is decided by the board of directors. However, investors also sometimes have a vote on whether they would like this to happen as well. So for example, if you're an investor and a shareholder in a company, sometimes companies will put out a vote for investors, and if they think that their share price is too high, they can decide to split the share price to a smaller amount, as I've just stated before. So moving on, we're going to go for an X to 1 split. So obviously X is a number that we don't know, but I'm going to be explaining it here. So a company may decide to split its stock in a number of ways. So for example, we can have a 10 to 1 split, 100 to 1 split, 1,000 to 1 split, 3 to 1 split, any kind of number that you want. And that's just how many shares has been divided in from the initial number. So for example, a 5 to 1 split means that the existing amount of shares have been divided by 5. Understandable, very easy to understand right there. So basically each share is now equivalent to 5 shares. So if you owned a share before in the market, that's now equivalent to 5 shares of the same stock. However, each share is worth less. So this means that the number of outstanding shares on the market will basically increase by 5 times. So outstanding shares are shares that are owned by investors. So yes, the number of shares will increase by 5 times. However, the price will stay the same. Now this one should be our last slide, because it's a very simple topic to understand. Reasons for a stock split, because this is kind of influential and important to know. So reasons may be prices are too high. So like I said before, that can be a detraction for the stock and a negative point actually, because it can dissuade some investors who might be wanting to invest in the company because they're just thinking the price is too high and I can't afford to pay that for one stock. So if prices get too high, the company may decide to split their stock. So a higher number of shares could also result in greater liquidity and investing potential for the company, like I just said, because while the stock value shouldn't change in theory, cheaper prices will often attract new investors, and that's understandable again. Like I said, if a share price is so cheap from what it was before, new investors might think, okay, now is a perfect time to get in, and that can be the turning point for them to get into the market. So it's understandable that this can change the price quite a lot. So in theory, the price should not change with a stock split, but because of people's bias or want to get in, more investors will probably come into the market. So stock splits are generally a good thing for the market. However, there are two types of stock splits. There's a stock split and there's a reverse stock split. So if you want to hear about a reverse stock split, I'll be explaining that one in another video, which will be out in a few days. So please like and subscribe. Anyway, I hope that you enjoyed this video. Very simple one for you, and I hope you found it fun. If you did, please check out any of the videos on screen. Greatly appreciated, and I will see you in the next one. Goodbye for now.